Welcome to my update for the S&P 500, plus I'll be going through some macro indicators. Please remember that I do these videos just for fun as a hobby, so always speak to an investment professional before making any investment decisions. So I like to zoom out to start with, all the way back to 1982, and take a look at the long-term trend for the S&P 500. And the first thing is it's quite clear that the value of the S&P 500 goes up over time in the long run. And this, of course, makes sense because we tend to have GDP growth of about 2% every year. Plus, on top of that, you've got to factor in inflation. So, because of that, it's no surprise that we see the price go up over time. And what's interesting to me is it seems to go up in a gradient up into around the credit crisis of 2008. And then after that, the gradient steepens. So before the 2008 credit crisis, we used to get these classic bubbles and then crashes, notably here the dot-com bubble and then the credit crisis. But then, as a result of the credit crisis of 2008, the government embarked on what I call here new Keynesian economics, where they started using zero interest rates and excessive money printing, which then resulted in the steepening of the gradient of the long-term trend. So you can see here how before the new Keynesian economics, we used to have these bubbles which then collapsed, the traditional economic cycles. However, post 2008, we seem to just stay broadly to the trend line. The exception being that when we had the corona crisis, there was this sudden drop, and then following the unprecedented burst of money printing all in one go, we got the FANG stock bubble. And here we can see how, using this new Keynesian economics, the Fed was fairly successful because from 2008, we see the interest rates drop down to nearly zero and the quantitative easing increase significantly. But that has been effective in keeping GDP up and the S&P 500 elevated. So I summarized new Keynesian economics here, and this is actually the dashboard that I use to assess the most important macro indicators. Here's the raw numbers here, but we can see that with the important ones, inflation is currently high. The official target for inflation is 2%, but actually I think they'd be quite happy with 4% because that way they could inflate away the government debt without the whole show breaking down. Well, currently inflation is 7%. Now, I get that 7% number because I don't like to use the year-on-year numbers. I use month-on-month CPI increases, which I bundle into quarters. And so extrapolating from that, that's how I say that we're currently at about 7% inflation. And so indeed, the trend has improved from how it was in 2022, but it's still fairly nasty at this 7% number. And GDP growth is actually surprisingly really good at about 2% at the moment. And the unemployment numbers are great at only 3.6%. So currently inflation is an issue, but everything else is looking great actually in the US economy. But all these other indicators are looking quite good. Now, this new Keynesian economics is something that's been enabled. They've only been able to do the low interest rates and quantitative easing, which are inflationary by nature. They've only been able to get away with that because we've been experiencing for several decades serious deflationary forces. There's the US dollar being a reserve currency in itself, plus the growth of the internet and technology, and also globalization. So these deflationary forces counteracted all of this NKE behavior, allowing the government to get away with meeting its objectives in this way. So we have to bear in mind that if there is a serious reduction in globalization, or the US dollar as a reserve currency, then that could then lead to everything falling apart. And so I do keep an eye on the artificially strong US dollar. In terms of government debt and fiscal deficit, I'll go into more detail later in the video, but it's actually not that bad. It's that these numbers are actually quite good compared with before the corona crisis as a percentage of GDP. But when we look at the Dixie, it has been weakening recently, but it's still fine actually compared with these historic numbers. But then when we look at yield curves, now this is what a yield curve is supposed to look like. This is the Japanese yen. And this is what the US dollar yield curve currently looks like. And it's actually inverted. And more worrying than that, the orange line here is 6 months ago, whereas the blue line is now. And we can see that the trend has got a lot worse in the last 6 months. So what I can say overall is that inflation is a problem at the moment, but otherwise the US seems to be good. However, there are some serious risks. They're probably unlikely, but they're more elevated than ever. So if there was a currency default, these are serious downside risks that we really need to factor in, particularly based on what's happening with the yield curve. So zooming into just the last 5 years, we see the S&P dropped 34% when we had the corona crisis, and then following imbecilic levels of money printing, there was a massive boom in the FANG stock, but then the FANG stock bubble burst, and we actually at the worst of it was 25% below the peak. Well, we're now currently 15% below the peak, but above where we were before the corona crisis. And this green line here, that's actually the long-term trend. And that formed a nice bottom of this symmetrical triangle that I'd drawn a few months ago, which we seem to be trading within. But actually, we've incredibly just broken out of that. Now, what I do is I put forward whatever future outcomes I could possibly think of, and then try and decide on which is the most probable to then factor in how I position my portfolio. And the best case would be this Goldilocks scenario. At the moment, I do find it unlikely. So, like I said, this green line is a long term trend. We may have a few more downturns in response to raising interest rates, etc. But over time, the inflation problem could go away with us avoiding a recession, and then we would return to the long-term trend line for the S&P 500. And so that explains my all hail NKE scenario here, where we avoid a recession and go back to normal. Now, I actually find this quite a compelling likelihood from where we are at the moment. There are some other risks, particularly the US dollar and these inverted yield curves. If we ended up with a full-blown currency crisis, then that would send us back down below the trend line. We'd shoot back down like we did at the COVID crisis. And also another possibility is if there is a worldwide recession, eventually that could impact the US enough that the US does fall into a proper recession, and again that would send us south. So my base case is I think we're going to be going in for this all hail NKE trend, but there is a serious risk of worldwide recession or currency crisis, which I then also have to factor in, even though I think it's less likely. So based on that, I have a target stance for my portfolio of 30% risk. I've had that now for many months, and I've decided to maintain that for another quarter because I'd like another quarter's data to help me determine where we're going, and also to factor in the risks of currency default and a few of these other things a bit better. So my portfolio is currently 26% risk, so I'm meeting my target. So to summarize, at the moment, everything looks great for the US apart from inflation, which is trending down. So I'm favouring the back to normal outcome. But there are key risks, particularly dollar collapse with the yield curve extremely inverted, and worldwide recession then impacting US GDP growth. So I'm remaining highly defensive, and within my equities, I want to target inflation, stagflation plays. So that's my executive summary that I like to do. But for those of you who like to dig into the detail a bit, I now go into the details in a bit more depth. So here's my basic data, which you can print screen if you want to take a look at that. Actually, the US economy was crazily in great shape, especially once unemployment recovered at the end of 2021. It was all looking good apart from the inflation going up. And then we got to a point at the end of 2022 when everything was looking quite good apart from inflation. And now, actually, generally, things are good in terms of the US economy. It's just inflation, but the trend for inflation is going down. In terms of interest rates, we can see that there was obviously a sharp acceleration. In fact, it's looking like a repeat of the last financial crisis, only only a bit of a steeper ramp up. But when we look at historic interest rates, we can see that back in the 80s and 90s, we used to get interest rates of well above the 5%. If the NKE model is maintained through this crisis, then fair enough, we probably are at the height of the interest rates. But if, for example, inflation was to go crazily out of hand, then these numbers, everyone looks at inflation of above 10% as unthinkable, but that was the norm in the past. So if we got into some kind of severe stagflation situation that lasted a decade or whatever, those kind of interest rate numbers are possible. In terms of quantitative easing and this 300 billion addition we had in March, that was getting us through the mini banking crisis we have. Here we've got quantitative easing, and we see how it was practically doubled since 2020, and so that explains how we had the FANG bubble. But the current trend isn't really for similar increase in QE. So although this step up in QE did then cause inflation, it does kind of make sense that as long as they stop the QE, then perhaps the inflation could normalize a bit. So inflation now was reduced. So the headline inflation numbers reduced to 5%, and the CPI month to month reduced to only plus 0.3%. I prefer to use month to month CPI, which I bundle into quarterly numbers to have a better amount of data to make a decision on. And so I work out currently extrapolated to a year, it's about 7% per year inflation at the moment. So it is worryingly high, and it kind of could go either way from here. Where, I'd say we're certainly not out of the woods yet. And when I look into the breakdown of the latest in CPI numbers, although the CPI now looks quite good, reducing to 5%, that was only because the energy component was negative 5%. So with OPEC Plus cutting production lately, it does concern me that the energy inflation, that energy benefit could go away. And so we could still have a inflation problem on the hands. Plus, also the core CPI was high at 5%, particularly in services. And so the fact is that, according to this data, this seemingly good numbers for March are actually bad numbers because the energy situation hidden the kind of reality of bad core inflation and the fact that this energy component is probably going to come back. So house prices, though, were surprisingly good. I used the Zillow data, and really we haven't had this house price crash that everyone was shouting about a few months ago. Any American viewers, if you think there's a better index or source I can use for house prices, please do say in the comments section. So GDP sales growth, and I get my 2% number using the GDP Now data. And they have the GDP Now at about 2.5%, and the blue chip consensus currently about 1%. So that's where I get my 2% from. Now, it's interesting to look at the long-term GDP growth. Now, this for me is actually the most frightening of all the data points in this video, because this to me looks like a exponential growth trend. And if you think of, if you plot bacteria growing in a petri dish or something, you get in nature, you get these exponential growth trends that then finally collapse as everything dies. And it looks to me that we have this same growth trend in terms of long-term GDP. And if this trend continues, the only outcome is Weimar Republic style inflation. So unemployment has been the one bright spot of the macro data. And we see here that where we are in a fairly sustained way is well below the historical norms. And so government debt is only 180% of GDP based on my rough estimations here. I used the latest quarterly GDP numbers and then times that by the current estimate of GDP growth to get to the current GDP numbers. And that's how I work out this government debt as a percentage of GDP and current GDP are better in terms of both fiscal deficit as a percentage of GDP and total GDP. These numbers are better than before the COVID crisis. So that's why I'm not too alarmed by these numbers, even if the nominal numbers are higher. But when we look at the fiscal deficit chart here, we see that the current fiscal deficit is actually in trend with what it used to be normally. And in terms of total debt, although we had a big jump up, it's now on a not too bad increasing trajectory. The main point being that as long as it's within a certain threshold of GDP, it probably shouldn't become out of control. Should China and other countries decide to stop using the US dollar as their reserve currency, then the US could find itself in a real pickle. So here I've got the US government debt versus GDP, and we'll know we'll be in the good days when they actually start paying down that debt, but still at least it's not running away from GDP. And here I have real GDP versus inflation, and we see that the inflation number is relatively high and the real GDP number is stagnant. So although GDP may be growing, because of inflation, nobody's actually any richer. And so that is classic stagflation. And my general kind of thesis at the moment is whatever happens, it's probably going to be a stagflationary period, or certainly a period of high inflation and of currency debasement, even if we see the S&P 500 going upwards. And so finally, these were the famous Fed box plots of 2020. This is what they projected inflation would do, and this is what's actually happened. And the same for GDP and for unemployment. They were actually fairly good when it came. They were actually fairly good with their prediction for unemployment. So, having gone over in more detail, I'm fairly convinced that for the S&P 500, the most likely outcome is this all hail new Keynesian economics. But when I go into the detail, there are some real nuances there, particularly the fact that when you take out the energy component, and with OPEC, with China apparently rising up again, and with OPEC Plus doing their oil price cuts, I really could see the inflation monster coming back to bite. I also, when I look at the inverted yield curve, I'm also not convinced that the Fed can cut interest rates like many are saying. And really, I do see this stagflationary trend forming. So, although this back to normal trend does seem likely, there are still there are still significant risks that could really upset things, and that's why all I can do personally is maintain a highly defensive portfolio and wait out another quarter to see if the data convinces me more that really are out of the hot water. So that completes my update for the S&P 500 and some macro indicators. I hope you enjoyed this video or found it useful. Please remember, I'm just doing these videos for fun as a hobby, so speak to your financial advisor before investing any of your own money. So keep well, and I hope you join me for my next video. Please read the disclaimer and remember that prices can go down as well as up.